The market that day behaved in ways few could explain. Within just hours, $400 million worth of asset-backed securities, known as ABS, were completely sold out, all rated at the highest credit grade. Under normal conditions, this level of rating is reserved for long-term mortgage-backed assets or government-guaranteed bonds issued by major U.S. banks. Yet the issuer in question was neither a bank nor a long-established institution. It was a young fintech firm that few retail investors had heard of, Pagaya Technologies, based jointly in Israel and the United States. Pagaya Technologies operates in the complex intersection between artificial intelligence and financial engineering. Using AI-driven algorithms, it reassesses consumer loans rejected by traditional banks and repackages them into investable securities for the capital markets. In essence, it transforms data, often discarded as too risky, into tradable assets. On paper, this looks like a triumph of technology over financial inefficiency. But beneath that innovation lies a paradox: a company that claims to distribute risk, yet seems unable to escape it itself. How can a firm issuing top-rated securities with a business model that supposedly minimizes exposure continue to post persistent losses? That is the mystery at the heart of Pagaya Technologies. The story begins in 2016 in Tel Aviv. Its founders, Gal Krubiner, Avital Pardo, and Yahav Yulzari, believed the credit system was broken. They argued that traditional credit scores failed to capture real borrower behavior and that millions of potentially reliable borrowers were being turned away by outdated scoring models. Pagaya's solution was an AI engine that analyzed vast streams of alternative data: spending patterns, recurring payments, online behavior, and even utility bills. This data was fed into a proprietary risk model designed to identify hidden good borrowers. The company's early promise lay in its ability to turn rejected loan applications into performing assets, effectively unlocking an entirely new credit segment. But that innovation came at a cost. The model's success depended not on conservative lending, but on continuous velocity of transactions. In June 2022, Pagaya went public on the Nasdaq via a merger with a special purpose acquisition company, or SPAC. Its valuation, roughly $8.5 billion. For a fintech firm barely 6 years old, this was remarkable. However, unlike a traditional IPO, a SPAC merger bypasses much of the due diligence and investor roadshows that serve as reality checks on valuation. The listing was fast, perhaps too fast. After debuting, Pagaya's stock price exhibited erratic behavior, swinging violently between $8 and $45. Such volatility is uncommon even among newly listed tech firms, suggesting the market